Hello and welcome back to the Young Investor Podcast. I'm Ali, and I'm really excited about today's topic because it's a big one. We're diving into something making headlines around the world: Japan's current economic turmoil. If you're a young investor, you might be wondering, Japan? Why should I care about what's happening over there? The truth is, what's going on in Japan's economy right now can teach all of us valuable lessons, and it might ripple through global markets in ways that affect our own investments. So, get comfortable and let's chat about it in plain English. We'll cover what's happening in Japan, things like surging bond yields, unexpected inflation, interest rate hikes, and even a bit of political drama. We'll discuss why it's happening, think huge debt, the end of an era of ultra-easy money, an aging population, and global inflation pressures. Then we'll explore the global ripple effects, how Japan's troubles could influence U.S. interest rates, stock markets, and currencies worldwide. Most importantly, we'll break down what it all means for you as a young investor. By the end, I'll share a few practical takeaways and investing lessons you can apply to your own financial journey. Sound good? Let's jump in. Why are people saying Japan is in an economic crisis or turmoil right now? Surging bond yields, Japan's government bond yields, the interest rates on its government debt, are shooting up to levels not seen since the late 1990s. After decades near 0%, this spike means investors want higher interest to lend to Japan. It's a warning sign that confidence in Japan's debt isn't what it used to be. Investors might be worried about inflation or whether Japan can easily pay them back in the long run. Inflation returns. For years, Japan was known for deflation or tiny inflation. Prices often fell or stayed flat. But now inflation is finally rising, hovering in the mid-3% range. That might not sound high if you live in a country that saw 8% inflation recently. But for Japan, it's the fastest price growth in decades. Everyday costs, food, energy, etc., are noticeably more expensive. Even staples like rice have jumped in price. This is catching people off guard in a place used to stable or falling prices. Interest rates are rising. The Bank of Japan, Japan's central bank, has started tightening monetary policy after years of ultra-loose money. In fact, they raised interest rates above 0% for the first time in 17 years. They kept rates at or below 0% since the early 2000s. This is a huge shift. Japan's central bank used to print money and buy government bonds like crazy to keep borrowing costs near zero. Now, faced with rising inflation, they've inched rates up, still very low, around 0.5%, but up nonetheless, and hinted they might let long-term rates climb more. Feels like the end of an era. Markets are jittery because they're not used to Japan rocking the boat on interest rates, and higher rates could slow the economy and make Japan's massive debt harder to manage. On top of the economic shifts, Japan is dealing with some political drama. An election is on the horizon, and there's a real chance the long-ruling party could lose some power or its majority. A new far-right nationalist party is gaining support, and opposition parties are making expensive-sounding promises, like big tax cuts and cash handouts to voters. Those policies might be popular, but they worry investors because they could mean even more government debt or unpredictable changes. Japan usually has pretty stable politics, so this uncertainty is unsettling. Investors hate uncertainty. They're thinking, who will be running Japan next? And will they spend a lot more money? This has contributed to pushing bond yields up as lenders get nervous, and has weakened the Japanese yen currency. It's a confidence issue. People aren't sure what Japan's economic policy will look like in the near future. Put all those factors together: soaring bond yields, rising inflation, the first interest rate hikes in ages, and political shakiness. And you can see why there's talk of an economic crisis or turmoil. It's like a perfect storm hitting the world's third-largest economy. Okay, so why are all these problems flaring up now? Japan's government has been piling up debt for decades, over 250% of its GDP, the highest debt ratio among major economies. Imagine someone who makes $50,000 a year but owes $125,000 on credit cards. Japan's situation is that extreme, but on a national scale. For a long time, this wasn't a crisis because interest rates were near zero, so debt was cheap to carry, and most of the debt was held by Japanese investors who weren't going to dump it. But now, with rising interest rates, the cost of paying interest on that huge debt is shooting up. Investors know Japan's debt is enormous. So if politicians talk about even more spending, like those election promises of cash handouts or tax cuts without budget cuts, lenders get nervous. They demand higher interest rates to compensate for the risk. In short, Japan's debt pile is a shaky foundation, and rising rates are widening the cracks. The Bank of Japan's ultra-loose monetary policy is finally changing. For years, the BOJ used tools like yield curve control, basically printing money to buy government bonds and cap their yields, to keep borrowing costs super low. This was like a safety blanket for Japan's economy and markets. No matter what, the central bank was keeping things calm and stable. Now that inflation has returned, the BOJ is stepping back. They've stopped rigidly capping yields and have raised short-term rates slightly. It's like taking off the training wheels. The market has to balance without constant central bank support. Investors are testing how far yields can rise now, and no one's sure what the natural interest rate for Japan is without heavy intervention. The transition is bumpy. Essentially, Japan is normalizing its monetary policy after decades, and that process is creating volatility and uncertainty in financial markets. Japan's demographic situation is a slow-burning challenge that underlies many economic issues. Japan has the oldest population in the world. Around 1/3 of Japanese citizens are over 65 years old, and the birth rate is very low. The population is actually shrinking. What does that mean for the economy? Fewer young workers and more retirees create a drag on growth. A smaller workforce can mean less innovation and productivity, while more retirees mean the government has to spend a lot on pensions and healthcare. That adds to the debt and limits economic dynamism. Japan has experienced years of low growth partly because of this demographic squeeze. In the current turmoil, an aging, shrinking population makes it harder for Japan to grow out of its debt or handle economic shocks. It's like trying to run uphill with a heavy backpack. Progress is slow. Investors are well aware of this issue, and it makes them cautious. Japan's long-term challenges make the current crisis harder to fix quickly. We also have to consider the global context. In recent years, many countries have been dealing with high inflation. The U.S. Federal Reserve, European Central Bank, and others hiked interest rates aggressively starting in 2022 to combat that. Japan initially held off from raising rates because its inflation was lower and officials worried the economy was too weak. But Japan couldn't ignore global forces forever. Here's what happened. As other countries' rates climbed and Japan stayed near zero, the yen weakened a lot against the dollar and euro. A weak yen made imports, like oil, gas, and food that Japan buys from abroad, more expensive in Japan, which pushed up domestic inflation. So global energy price spikes and supply chain issues eventually hit Japan through a weaker currency. Also, worldwide, investors started expecting higher returns due to inflation and large government spending during COVID. Japan's bonds had been an outlier with super low yields. As global investors reevaluated risks and returns, Japan felt pressure to let its yields rise too, or otherwise, money would flee Japan for better returns elsewhere. Another global twist. There were even talks about international trade frictions, like potential U.S. tariffs on Japanese goods, that added to economic uncertainty. In short, Japan's turmoil isn't just homemade. Global inflation, strong foreign currencies, and worldwide investor attitudes have all caught up with Japan's long-running policies. Japan could no longer be a low-rate island in a high-inflation ocean without facing some stormy seas. So why now? In summary, Japan is facing this turmoil because of a combination of huge debt and an aging society at home, the long-awaited shift away from decades of easy money, and global economic tides like inflation and rising interest rates elsewhere that finally rolled onto Japan's shores. It was almost a when, not if situation, and that when is now. You might be thinking, all right, Japan has issues, but how does that affect me or the markets in my country? In today's interconnected world, a crisis in one major economy can send ripples everywhere. Here are some ways Japan's situation is impacting, or could impact, the global financial scene. When a giant like Japan sees its bond yields rise, it can tug other countries' rates up too. Here's why. Japanese banks, pension funds, and investors have trillions invested abroad in U.S. treasuries, European bonds, etc., largely because yields in Japan were near zero. Now that Japanese yields are climbing, those investors might bring some money home. If they start selling off foreign bonds to invest more in Japan, that lack of demand or sudden selling pushes yields up in other countries. We've already seen hints of this. For example, U.S. long-term interest rates have nudged higher, and analysts point to Japan as one reason. Even central bankers like the U.S. Federal Reserve are watching Japan's moves. If global borrowing costs rise due to Japan, the Fed might have to factor that into its own interest rate decisions. It's not just big Western economies that feel the squeeze. Emerging markets could get caught in the ripple effect too. When global investors, including the Japanese, pull money from riskier markets to cover losses or seek safety back home, countries like those in Asia, Latin America, or Africa can suffer. These nations often rely on foreign investment to fund their budgets and growth. If Japanese and other investors withdraw funds, borrowing costs for those countries can spike and their currencies might weaken. In past global tightening cycles, we've seen some emerging economies face real stress, difficulty paying debt, inflation from weak currencies, etc. So Japan's turmoil, by prompting a shift in global capital flows, could indirectly make life harder for far-off economies that had nothing to do with Japan's domestic issues. Stock investors worldwide have their eyes on Japan's situation. Financial markets are connected by investor sentiment and money flows. When headlines scream, "economic crisis in Japan," investors in New York or London can get nervous, leading them to be more cautious. Also, rising bond yields, like we're seeing due to Japan, create competition for stocks. Remember when interest rates were near zero? There was a saying, "There is no alternative, Tina, to stocks because bonds paid nothing?" Well, now there is an alternative. Bonds are paying more, which can make stocks slightly less attractive by comparison. High-growth tech stocks, in particular, often take a hit when interest rates rise, because their future earnings are less valuable when discounted back to today at higher rates. We actually saw U.S. tech shares wobble on days when Japanese yields spiked unexpectedly. A bit of a chain reaction. Additionally, many multinational companies do business in Japan or depend on Japanese consumers. If Japan's economy slows or the yen swings wildly, it can dent those companies' profits. For instance, an American electronics company selling a lot in Japan could earn less if the yen is weak. Their Japanese revenues convert to fewer dollars, or if Japanese consumers cut spending. So your stock portfolio might experience some swings partly thanks to events in Tokyo, even if you've never invested directly in Japan. The Japanese yen is a major global currency, and it's been on a roller coaster. Typically, the yen is seen as a safe haven. When there's trouble in the world, people buy yen, making it stronger. But recently, the yen fell to multi-decade lows against the US dollar because Japan kept its interest rate so low while the US jacked theirs up. A weak yen helped Japanese exporters for a while. Their products got cheaper overseas, but made imports pricey for Japanese consumers. Now, if Japan's central bank is tightening and if investors start unwinding the famed yen carry trade, where they borrowed yen cheaply to invest in higher yield assets abroad, the yen could strengthen very quickly. We could see big swings. In fact, we already have. This kind of volatility can unsettle other currency markets too. For example, if the yen suddenly surges, other Asian currencies might move in reaction, and countries might intervene to stabilize their currencies. For investors, currency moves can affect your returns. If you own international investments, a stronger yen versus your home currency could either help or hurt your performance depending on which side you're on. And for everyone, currency swings can influence trade and prices. A strong yen could make Japanese goods pricier abroad and foreign goods cheaper in Japan, shifting some economic dynamics. In short, keep an eye on the yen. Its turbulence is part of the global ripple effect story. In all these ways, Japan's economic turmoil isn't confined to Japan. Think of Japan as a big stone dropped in the global pond, the waves spread outward. We're seeing a world where bond markets, stock markets, and currencies are all interconnected. Even if you have no investments in Japan, what's happening there can subtly influence the financial environment you're investing in. So, As a young investor, what should you take away from Japan's economic roller coaster? First off, remember that even big economic turmoil in one country doesn't mean the sky is falling everywhere. It's easy to get spooked by scary headlines, but use them as learning opportunities rather than reasons to panic. Markets go through ups and downs. If you have a long investment horizon, which you do as a young investor, most short-term crises will just be bumps in the road. So, keep your cool, stick to your plan, and focus on your long-term goals. Riding out storms is part of the investing journey. Japan's story is a reminder that interest rates are a big deal. We came out of a decade where money was super cheap and rates were near zero. You might not have paid much attention to central banks if you started investing then. Now, with rates rising globally, even Japan is finally inching up. The game has changed. Higher interest rates affect everything. The cost of your future loans, student loans, mortgages, how companies grow, since borrowing is pricier, and how investments perform. For example, in a high-rate environment, companies carrying a lot of debt might struggle due to higher interest costs, while banks might do better because they can earn more from lending. As a young investor, start tuning into what central banks are doing. You don't need to obsess but recognize that the era of near-zero rates is over, for now. When you hear news about rate hikes or cuts, know that it can ripple into stock prices, bond yields, and even the job market. Being aware of this makes you a more informed investor. Bonds have been pretty boring for the last decade. They paid almost nothing in interest, so many young investors ignored them. But with yields rising in Japan, in the US, and elsewhere, bonds are becoming attractive again. This means a couple of things for you. One, you might actually consider having some bonds or bond funds in your portfolio now, because they can provide steady income and balance out the risk of stocks. Two, it's a great time to learn the basics of bonds if you haven't already. Understanding how bond yields and prices work and how they're tied to interest rates will give you an edge. For example, longer-term bonds can lock in today's higher interest rates, and shorter-term bonds or savings accounts are paying more than they have in years. The main point, don't write off bonds as for old people or boring. The investing environment is shifting, and a well-rounded portfolio usually includes some bonds for stability. Japan's situation, where everyone is suddenly paying attention to bond yields, drives home that lesson. One big lesson from any single country's crisis is diversify, diversify, diversify. If you had all your money in Japanese stocks or bonds, you'd be in a tough spot this year. The same goes for any country or single asset class. By spreading your investments across different regions and types of assets, you reduce the risk that one bad event sinks your entire portfolio. Maybe you mostly invest in US stocks, that's fine, but consider having some international exposure too, because sometimes the US might struggle while another area does well, and vice versa. Or if you're 100% in stocks, think about a mix that includes some bonds or other assets to cushion against stock market volatility. Diversification is about not putting all your eggs in one basket. You don't have to predict which country or sector will have trouble next. By being diversified, you're automatically more prepared for whatever comes. Japan's woes are a reminder that every market has unique risks, so balance them out by owning a bit of everything. You don't need a PhD in economics to be a good investor, but paying some attention to global trends can really help. Japan's saga illustrates how things like demographics, debt levels, and central bank policies matter in the long run. It pays to stay curious about the world. Is a country's population young and growing or old and shrinking? Is debt piling up unsustainably? Is inflation heating up or cooling down? These big-picture factors can affect the stock market's direction or the safety of bonds or the strength of a currency. By being aware of macro trends, you won't be as surprised by events like what's happening in Japan. You'll understand the context. Plus, this knowledge can guide your strategy. For example, if you know a lot of countries have aging populations and rising debt, Japan today, but also some others, you might be more cautious about those markets, or you might favor industries that benefit from an older population like healthcare. In short, be a student of the global economy in a casual way. It can make you a more resilient and opportunistic investor. Above all, remember that as a young investor, time is on your side. Events like Japan's turmoil can be serious, but they're also temporary in the grand scheme. The key is to learn from them and adjust your tactics a bit, without losing sight of your long-term strategy. Let's wrap up with a quick summary of the key lessons from Japan's economic turmoil, especially as they apply to young investors. Central bank moves matter. Don't ignore what central banks like the Bank of Japan or U.S. Federal Reserve are doing. Changes in interest rates can impact your loans, the stock market, and the economy. We're in a period where rates aren't near zero background noise. They're driving market behavior. Pay attention to rate hikes or cuts. They can ripple through to your finances. With yields rising, bonds have become more appealing than they've been in years. It might be time to include some bonds or high-yield savings in your portfolio for stability and income. In other words, don't sleep on bonds now. They can play a valuable role in balancing risk and reward. Japan's troubles remind us not to bet everything on one country or one type of asset. Spread your investments across different assets, stocks, bonds, etc., and regions. Diversification is the best defense against surprises and a way to benefit from growth in various parts of the world. Keep an eye on major global economic trends, inflation, debt levels, demographics, etc. You don't need to track every detail, but understanding the big picture will help you make sense of market moves and not be caught off guard by events like this. Being informed will make you more confident and better prepared to adjust your investing strategy when needed. Market turmoil will come and go. If you have a solid long-term plan, whether it's saving for a house, retirement, or financial independence, stick to it. Don't let short-term noise derail you. Often the worst mistake is to panic sell during a crisis. Instead, stay calm. And if you have the means, sometimes market dips can even be opportunities to invest at better prices. Patience and consistency are your allies. So, there you have it, Japan's current economic roller coaster and what it means for the rest of us, all in a nutshell. We covered what's happening in Japan, from bond yields to politics. Why it's happening, debt, policy shifts, demographics, global forces, the global ripple effects, and the lessons you can take away as a young investor. The big takeaway is how interconnected the financial world is today. Something happening in Japan can teach important lessons and subtly influence the environment for all investors. If this episode sparked your interest, I encourage you to keep learning about these topics. Understanding things like inflation, interest rates, and global markets will make you a more confident investor, even when headlines get scary. And hey, you might even impress your friends by casually explaining what's up with Japan's bond yields. Thank you so much for listening. I hope I was able to break down this complex story in an accessible way. If you enjoyed this episode, please consider subscribing and leaving a review. It really helps us reach more young investors like you. And as always, feel free to send in any questions or topics you'd like me to cover in future episodes. I love hearing from you. Until next time, stay curious, stay calm, and happy investing. You've got this.